Picture this. You finally do the responsible thing. You start saving money. Every month, you move a little bit into your savings account. $100 here, $200 there. You feel good about it. Responsible, disciplined, financially mature. But then one day you open your banking app and realize something strange. Your savings account has $10,000 sitting there, and it's earning something like 0.5% interest, which means after an entire year you've made just $50. Meanwhile, you keep hearing people talk about investing, stocks, index funds, compound growth, and suddenly you start wondering, wait, am I doing this wrong? Because saving money is good, but saving alone rarely builds serious long-term wealth. And this is where a lot of people get stuck. They know saving is important, they know investing is important, but nobody really explains what you're supposed to do in between. How much should stay in cash? When should you start investing? What happens if the market crashes? Should you buy individual stocks? Should you use index funds? And what if you make a mistake? So in this video, we're going to simplify the entire process. I'll show you how to go from simply saving money to actually putting that money to work without gambling your financial security. Because the goal isn't to take your savings and throw them into the stock market. The goal is to build a system where your money has two jobs. One part protects you, the other part grows for you. And once you understand that difference, investing becomes a lot less intimidating. Let's start with something that sounds simple, but completely changes the way you think about money. Saving and investing are not competitors, they're teammates. Your savings account is there to protect your present. Your investments are there to build your future. And confusing those two jobs is one of the biggest financial mistakes beginners make. Think about it. Imagine you have $10,000. If that money sits in an account earning 1% a year, you'd have roughly $10,100 after 1 year. Your money is safe and accessible. That's useful. But it isn't doing much growing. Now imagine, purely as a hypothetical example, that the same $10,000 compounds at an average 8% annual return over a long period. After 20 years, it could grow to roughly $46,600. That's a massive difference. But here's the important part. That 8% isn't guaranteed. Markets don't move in a straight line. You could have years when your investment goes up dramatically. You could also have years when it falls. That's why comparing a savings account and the stock market using only 1 year's return can be misleading. They have completely different purposes. Cash gives you stability, investments give you long-term growth potential, and the smartest financial system uses both. Now here's where most beginners go wrong. They think investing starts with choosing a stock. It doesn't. Investing starts with getting your financial foundation right. So let's build that foundation step by step. The first step is something most people skip because it's not exciting. Build your emergency fund. Before worrying about maximizing investment returns, make sure you have enough cash to survive an unexpected problem. Maybe you lose your job, maybe your car needs an expensive repair, maybe your rent suddenly becomes difficult to cover, maybe an unexpected bill appears out of nowhere. Life doesn't care about your investment strategy. It can send you an expense at the worst possible time, and that's exactly why an emergency fund exists. A common target is around 3 to 6 months of essential living expenses, not 6 months of luxury spending, not 6 months of vacations. Your essential expenses: rent, food, utilities, transportation, insurance, basic necessities. And that money should generally remain somewhere safe and accessible because your emergency fund has one job: not to make you rich, to make sure you don't have to sell investments at the worst possible moment. And that distinction is incredibly important. Imagine the stock market falls 30%, your investments are down. At the same time, you suddenly lose your job. If you have no emergency savings, what happens? You may be forced to sell your investments while they're down. That's how a temporary market decline can turn into a permanent financial loss. But if you have cash sitting on the side, you have breathing room. You can focus on solving the emergency instead of worrying about the stock market. Your emergency fund doesn't just protect your money, it protects your investment strategy from your life. Now let's move to step 2. Separate your money mentally. Imagine you have 2 buckets. The first bucket is your safety bucket. The second bucket is your growth bucket. Your safety bucket contains money you may need relatively soon: emergency expenses, near-term goals, bills, money that cannot afford to experience a major decline. Your growth bucket is different. This is money you don't expect to need for many years. Its purpose is long-term growth. And because it has a longer time horizon, it can potentially tolerate short-term market fluctuations. This simple separation can completely change how you feel about investing, because when the market drops, you don't look at your entire financial life and think, I'm losing everything. You can say, my emergency money is still there, my bills are covered, my investments are for the long term. That psychological difference is huge. And speaking of psychology, this is where investing gets really interesting, because investing isn't primarily a math problem. For most people, it's a behavior problem. Almost everyone understands that buying low and selling high sounds good. The problem is that markets don't announce when the bottom has arrived. When prices are rising, everyone feels like a genius. People start thinking, why didn't I invest more? Then the market falls. The headlines become terrifying. Markets crash. Recession fears. Investors panic. Billions wiped out. And suddenly that same person who was excited about investing 3 months ago wants to sell everything. That's the trap. They weren't investing based on a long-term plan. They were investing based on emotion. And emotions are terrible portfolio managers. This is why step 3 is so powerful. Start small. You don't need to begin with $50,000. You don't even need to wait until you feel like an expert. You can start with an amount that doesn't make you uncomfortable. Maybe it's $50, maybe $100, maybe $300. The exact number matters less than creating a repeatable habit, because your first goal isn't to become rich. Your first goal is to become an investor. Those are two very different goals. When you invest your first $100, you're not going to transform your financial life overnight, but you're learning something much more valuable. You're learning how markets behave. You're learning how you personally react when your account goes up. You're learning how you react when it goes down. You're learning patience. You're learning consistency. And you're building a habit that can potentially continue for decades. That's much more important than trying to find the perfect stock on day one, which brings us to step 4. Don't make investing unnecessarily complicated. This is where social media can become dangerous. Open TikTok, YouTube, Instagram, or any investing forum, and you'll find someone talking about the next stock that's supposedly going to explode. Someone is trading options. Someone is making money from cryptocurrency. Someone is showing a screenshot of a huge return. Someone is claiming they turned $1,000 into $100,000. And suddenly a beginner thinks investing is about finding the next big winner. It isn't. For many long-term investors, simple diversification is far more important than trying to predict which company will become the next superstar. One common way to get broad diversification is through index funds or ETFs that track a broad market index. Instead of betting everything on one company, you can own pieces of many companies through a single fund. That means one company having a terrible year doesn't necessarily destroy your entire portfolio. And this is one reason broad low-cost index investing has become so popular. You're not trying to predict the future. You're essentially saying, I don't know which company will dominate the next 20 years, so I'll diversify. That's a completely different mindset. You're not trying to become a stock-picking genius. You're trying to participate in long-term economic growth. And historically, even Warren Buffett has repeatedly pointed ordinary investors toward low-cost index funds rather than complicated strategies. But there's something else you need to understand. An index fund doesn't eliminate risk. It doesn't guarantee profits. The market can still fall, sometimes dramatically. The advantage is diversification and simplicity, not magic. And now we reach one of the most important parts of this entire strategy: consistency. Let's say you invest $300 every month. That's $3,600 per year. Now imagine, purely for illustration, that your investments compound at an average 8% annual return over 25 years. Your total contributions would be $90,000, but the account could grow to roughly $285,000. Where did the other roughly $195,000 come from? Growth. That's the power of compounding. And notice something important. You didn't need to invest $285,000. You didn't need to make one incredible investment decision. You simply kept putting money into the system and gave it enough time. This is why time can be more valuable than trying to find the perfect investment. Someone who starts investing at 22 with a modest amount can potentially have a huge advantage over someone who waits until 35 and then tries to invest aggressively. The earlier money gets into the system, the longer it has to compound. And that's why one of the most expensive sentences in personal finance is, "I'll start later." Later sounds harmless, but 5 years becomes 10, 10 becomes 15. And suddenly you've lost years of potential compounding. You don't need to be rich to start. You need to start within your financial limits. Now let's talk about something that scares almost every beginner: market crashes. Because eventually, the market will fall. That's not a possibility. It's part of investing. The stock market has experienced recessions, wars, financial crises, pandemics, political uncertainty, inflation, and countless other shocks. And every time prices fall sharply, investors hear the same question: is this the end? Usually the answer is no, but that doesn't mean every investment recovers or that every company survives. That's why diversification and a long-term approach matter. Now imagine you're investing $300 every month. The market is doing great. Your account looks fantastic. Then suddenly the market falls 25%. Your account balance drops. It feels terrible. But if you're still earning an income, your monthly investment hasn't disappeared. You're now buying investments at lower prices. That doesn't mean a crash is automatically good. Losses are real, and there is no guarantee about when markets recover. But for a long-term investor who continues contributing, falling prices can create opportunities to buy more shares with the same amount of money. This is one reason consistency matters. Consistency matters because you're not trying to predict exactly when the market will rise or fall. You're simply following your plan through different market conditions. That's very different from trying to time the market. One mistake beginners make is waiting for the perfect time to invest. They say, "I'll invest when the market falls." Then the market falls and they're scared, so they wait. Prices recover and they say, "I'll wait for another crash." Eventually, they realize they've spent years waiting for certainty that never existed. There is no perfect moment. There is only a financial plan that makes sense for your situation. That's why automation can be powerful. Instead of asking every month, "Should I invest?" you can potentially automate a contribution according to your plan. Essential expenses are covered, your emergency fund is maintained, and a predetermined amount goes toward long-term investing. Now investing becomes a system, not an emotional decision. And systems are powerful because they remove decision-making from moments when your emotions are strongest. But there's one more thing you should handle before aggressively investing: high-interest debt. If you're carrying extremely expensive credit card debt, earning an investment return while paying a very high interest rate can put you in a difficult position. For example, if a debt is charging you an extremely high interest rate, paying that debt down can be a very valuable financial move. So your financial order might look something like this. First, control your basic spending. Second, build an emergency fund. Third, deal with expensive high-interest debt. Fourth, take advantage of relevant employer retirement benefits if available. And then, build your long-term investment portfolio according to your goals, risk tolerance, and time horizon. The exact order can vary depending on your situation, but the principle is simple. Don't build a beautiful investment portfolio while your financial foundation is collapsing underneath it. Now let's talk about something nobody likes hearing. You don't need to constantly check your investments. In fact, checking your portfolio every 5 minutes can make you a worse investor. Imagine you invest $10,000. You check it every day. Monday, $10,120. You feel great. Tuesday, $9,870. You feel nervous. Wednesday, $9,540. You panic. Thursday, $9,900. You feel relieved. Friday, $9,620. Now you're thinking about selling. Nothing fundamental about your long-term goal changed, only the price changed. And because you watched every movement, your emotions started making decisions for you. Long-term investing requires a strange kind of patience. You have to accept that your account can look worse before it looks better. You have to accept uncertainty. You have to accept that some investments will perform poorly. And you have to understand that volatility is not necessarily failure. Sometimes volatility is simply the price you pay for long-term growth potential. Think of it like planting a tree. You don't dig up the seed every morning to check whether the roots are growing. You plant it, you water it, you protect it, and then you give it time. Investing is similar. Your job isn't to stare at the soil every day. Your job is to create the right conditions and give the process time. Now let's bring everything together. Imagine someone earning a regular income. Every month, money comes in. Instead of spending everything and hoping there is something left over, they create a system. First, they know their essential monthly expenses. Then they build an emergency fund. Then they eliminate expensive debt. Then they decide how much money can realistically be invested every month. They choose a diversified long-term investment strategy. They automate contributions. And when the market rises, they stay invested. When the market falls, they don't automatically panic. When the news becomes terrifying, they remember why they started. And when everyone starts talking about the next hot investment, they don't abandon their plan just because something sounds exciting. That's what financial discipline looks like. Not getting rich overnight, not predicting the market, not finding some secret stock, just making sensible decisions repeatedly for a very long time. And here's the biggest lesson. You don't become wealthy because you found one magical investment. You build wealth by creating a gap between what you earn and what you spend, and then consistently putting some of that gap to work. Your income matters. Your savings rate matters. Your investment returns matter. But time matters enormously. That's why the question isn't, how can I make the most money this year? A better question is, how can I build a financial system that I can follow for the next 20 years? Because 20 years of consistency can be far more powerful than 20 months of excitement. Saving gives you stability. Investing gives your money the potential to grow. And discipline gives both of them a chance to work. So if you're sitting on a pile of cash right now and wondering what to do next, don't feel pressured to invest everything tomorrow. You don't need to. Start with the foundation. Know your expenses. Build your emergency reserve. Separate short-term money from long-term money. Deal with expensive debt. Then start investing an amount you can comfortably maintain. Keep it diversified. Keep the costs low. Keep learning. And most importantly, stay consistent. Because the goal isn't to become the person who made the biggest return last year. The goal is to become the person who is still investing 20 years from now. And that's the difference between chasing money and building wealth. So, where are you right now? Are you still in the saving stage? Are you building your emergency fund? Or have you already started investing? Let me know in the comments. And if you found this video useful, subscribe. Because understanding money is one thing, but actually building a system around it is where your financial future starts to change.